Hello, everyone, and welcome to this month's session of the Economic and Investment Update. For this session, I'm happy to introduce our new Chief Investment Officer, Ben Seeger-Scott. Ben is taking over from David Baker, who customarily did those calls with me. David is still very much part of the business. In fact, he's leading it now as head of financial planning. And Ben has joined us to pick up his role as Chief Investment Officer. So as it is customary, we will start with markets and with Ben.
Thank you very much, George. Good morning, everyone. Really great to be here. I've been at Mazars for just over a week, already getting the hang of it. So please, as always, throw any questions you may have at us. There's a Q&A box at the bottom. I might dodge one or two if they're particularly specific and I haven't yet figured out how to find it on a system, but certainly anything market, investment and macro related, I'm very happy to have a crack at. And as George said, we'll go through the usual order. Markets first that I'll sort of cover off, then I'll hand over to George to talk about some of the fundamentals. Starting on this slide, and this really encapsulates a lot of the key discussion points of the last few months, and this is the ongoing equity rally. Equities continue to go from strength to strength. You can see here the S&P 500, the largest 500 companies in the US, really a bellwether for global equities more broadly. And you can see over the last few years, bounced around a little bit, but we've had this sustained rally really since November last year. Now, people always say, what's driving it? The reality is always a whole myriad of factors. But to me, there are certainly a couple of themes that are worth highlighting now and then building on through the rest of this presentation. And what it really started with in November was what I think of as a relief rally. We spent most of the last couple of years worrying about central banks and interest rates from the Federal Reserve, the Bank of England, getting higher and higher. And at some point we knew they'll pause. Once they pause, they can start talking about cuts, which is where we are now. Cuts are good for economies. And that relief rally that finally central banks have stopped hiking, that really started in November and December with a lot of the rhetoric coming out of those central banks. That relief rally then fed into a continuation of the AI rally, so artificial intelligence, the potential productivity gains, and all of the enthusiasm around that really built in to another leg to reinforce that rally. And in markets, you tend to get these self-fulfilling prophecies. Consumer sentiment, investor sentiment is very powerful. As markets have gone up, investors have at the same time had a bit of a fear of missing out, so wanting to get involved. That drives momentum. They also start to feel better off. They feel more secure. They think markets are doing well. They feel more secure in their jobs, in themselves. They feel richer, so are happy to spend more and put more into the market. And that's really led this extended rally of the last few months. And a lot of that has been driven by consumption. That's a point we'll come back to. So that's in the broader context. We can go to the next slide, please, Jordan. Looking at the year so far, there has been a sense that everything's been led by the Magnificent Seven. These are the 7 mega cap tech stocks at the top of the US market. That was certainly true last year. The Magnificent Seven really driving the broader market and pulling the rest of the market along. But actually, since the start of the year, what we've seen is this rally broaden out. So this is just year to date. Yes, the Magnificent Seven are still up there, but actually other markets are continuing to do well. The broader S&P 500 is up there. Value is still participating. You can see Europe doing very well as well. Not on here, but Japan, also another market that is doing well. So this rally is really broadening out. Some similar segments in Europe are doing as well as the Magnificent Seven. So we're starting to see that continue in a much broader sense, which leads us to the key question of, look, that we've had a great time. Can it continue? That's going to be something we talk about through the rest of this presentation. Particularly, will fundamentals carry on driving? Are earnings and economic activity going to drive this? Because yes, price action can have a lot of momentum, but price action cannot sustain rallies ad infinitum. Indeed, around the edges, we're starting to see what might be considered a few signs that some of the shine might be coming off. One measure is insider activity. This isn't the illegal insider trading. This is just owners, the owners that are executives in the business. Are they buying or are they selling? And actually, what we see is those insiders are selling the relative sales to buys. They're selling at the fastest rate since 2021, and that's quite broadly spread. But quite well-known names like Mark Zuckerberg at Facebook or Meta, Jeff Bezos at Amazon are all in that list of people selling. So maybe that's a signal that we will start to look at. So that's equities at a top level. I always find it useful, though, to decompose this into two underlying lenses. So if we go on to the next slide, the way I tend to look at equities, there's two key elements to look at. One is fundamentals, that's the underlying business growth, and the second is the valuation you place on those fundamentals. So up on the screen now, this is a price to earnings ratio, just looks at the price compared to the earnings. It's a pretty typical valuation measure that lots of you will be familiar with. This is global equity, so the MSCI World. The bar along the middle shows the average over the time period. And what you can see, a lot of this price action has moved valuations higher. Equities aren't moving up because earnings continue to grow apace. A lot of the movement has been in the price and in the valuation. So people are valuing these equities more highly despite no major change in the underlying conditions. Of course, a global aggregated index hides some of the detail. In particular, the US is looking a little bit expensive. Areas like the UK, Europe, and emerging markets are looking a bit cheaper. But since the US is the dominant market, it pushes the overall index up. And there are some points, another way of looking at this later. But do remember, price to earnings ratio is a useful valuation measure, and the valuations are looking a little bit rich at the moment. So if those are the valuations, on the next slide, we've got fundamentals. So what is it we're valuing? Earnings are sort of a base case way of looking at these. And what this shows is that same index, the MSCI World, but how are earnings expected to grow over the next few years? And you can see actually earnings growth is pretty strong. Compared to the last 12 months, the next 12 months, we think global earnings growth, or markets believe global earnings growth is going to grow around 5%. And actually for the next year, so 2025 full year, another 11% on top of that. That tends to be considerably higher than, particularly that 11%. Double-digit growth is higher than we would typically expect. So to some extent, valuations look expensive, but they're anticipating some of this higher earnings growth, and that's really what's driving markets. It's important to remember that fundamentals are sustainable. There's only so far valuation can go before it tends to snap back. Valuations are fickle, but earnings growth is more sustainable. If you can continue compounding up that earnings growth, that's what leads to long-term growth in equity markets. And if you're an equity investor, it's really that long-term compound earnings growth that one tends to focus on. So that's equities, maybe not as stretched as they look at first, but certainly a lot of expectation already baked in. The other major asset class we can turn to on the next slide is bonds. Sorry, is there one slide before that? Yes. Yeah, that one, thank you. So this is bonds. We're just going to look at government bonds here. The US 10-year government bond is a pretty useful benchmark for considering the world. What we have here is the yield on those bonds, on that debt. Yields move in the opposite direction to price. So when the chart goes up, the yields rise, prices fall, but the yield becomes more enticing. The yield on offer is what we as investors look at and what draws us to this asset class. You can see a few years ago when yields were near zero, you were looking at taking on quite a lot of risk and not being rewarded for it. It's a very unattractive trade. As those yields have sold off over the last couple of years, they've become that much more attractive. As we are now, a yield of 4% actually looks pretty good to my eyes. A 4% yield is a good number, a good return in an absolute sense. But also, if you think inflation is going to be 2 to 3% over the next 10 years, getting 1 or 2% above inflation from government bonds, which is a relatively low risk asset class, particularly if held to maturity. Nothing in this sense, of course, is completely risk free, but held to maturity, it tends to have a lower risk characteristics than something like equity. Getting a 4% yield on that can look pretty attractive. And again, we can decompose this into some other aspects. I do that on the next 2 slides. So if that's where we are now, we need to worry, are these yields going to blow out further? Potentially, I don't know. But the slide just before this, actually, Jordan, looks at interest rate, the one after, that one. Perfect, thank you. Couple of ways to look at bonds. Firstly, in terms of interest rate expectations. This chart shows, again, market implied. This isn't necessarily our view. There are risks to the upside and downside, but I'm just showing what markets are currently pricing in for interest rates over the next 3 years, both in the UK and in the US. Pretty similar story on both sides of the Atlantic. Where we are now in the UK, 5.25%. Remember, this time last summer, we were starting to fret that maybe interest rates would start with a 6, and that would be really painful. I speak from experience. I've currently got a tracker mortgage. I can tell you I've been watching this very closely for the last few months. But actually, rates are sort of topped out with a 5 handle in the low 5s, and the market expects rates to steadily fall over the next 3 years to maybe something starting with a 3 handle. And that gives me some reason for reassurance. Markets aren't expecting things to get wild from here. So maybe that 4% yield on the 10-year government bond looks relatively defensible. Of course, what happens in the interim, the risks to this view when that first cut happens, that is of interest to us. That's something George will talk about a little bit later. But just in that slightly longer term time frame, I don't have huge reasons to worry, certainly based on the market outlook of where those rates may go based on interest rates. The other thing we think about with bonds, of course, is inflation, which is on the next slide. This is going to be a slightly volatile series, but yes, thank you. What you can see here, this is 10-year break-even inflation expectations. Back one. That one, yes, thank you. This is a longer term measure. This shows what the market expects inflation to be on average for the next 10 years in each of these regions. I accept it's a slightly noisy chart. And what you can see, the US, Germany is our representative European country, and the UK at the top. So this is what inflation has done over this period. This is at any point in time what markets are implying inflation will be for the next 10 years. And I will just highlight 2 things. I put the longer series here for context, but I think there's 2 key points, maybe 3, to draw out. The first is that if you look in that 2022 to 2023 region, you can see that's when these series are very volatile. That's when inflation expectations became de-anchored. And central banks tend to look through the short-term noise and worry much more about longer-term inflation expectations. When this became volatile, when this bounced around, that's when central bankers started to worry that inflation was becoming de-anchored. What we can see over the last few years, as that volatility has died down, central banks are much more relaxed. That long-term inflation measures are anchored. In the US and Europe, around the 2%. The UK is higher, but an oddity in the way this is calculated, it uses RPI rather than CPI. As a rule of thumb, you can take about 1 percentage point off RPI to get to CPI. So again, in the UK, expectations are for about 2.5% CPI inflation over the 10 years. Compare that with the number I said before of 4% yield, government bond yield. That gives me comfort that actually markets are looking relatively relaxed. Again, George can talk about some of the details on that. Only a couple more slides for me to talk to. If I talk about the next one, what I've done thus far is talk about equity and bond markets in isolation. When we think in terms of portfolios, we need to think about the blend between the two, where we have what. This chart here, this is a relative performance chart. That blue line, dark blue line in the middle shows bonds relative to equities. When it goes up, equities are outperforming bonds. When it goes down, vice versa. The line in the middle shows the sort of trend for that, and the bars either side show the standard deviation. And the key point is that over the last few years, last 2 years in particular, equities have significantly outperformed bonds by quite a strong trend. And the key point to us is that justified? The next chart, which is another way of looking at this, suggests that whether or not that continued outperformance is justified is questionable. What this chart shows, recall I talked earlier about the price to earnings ratio, which is a valuation measure. We can turn that the other way around and create an earnings yield. So this isn't dividends, this is company earnings compared to the price. What is the yield this equity is giving me? And in markets, most investing is about looking at some sort of yield, seeing if you're being offered the right level of yield for taking that risk. So what we do here is we take the earnings yield on the index, we compare it to the government bond, which is effectively close to a risk-free rate, and saying which looks more attractive. And what you can see here, this is sort of fleshing out what I said earlier about the detail in valuations. In the US, the yield on equity is now lower than what you're seeing on government bonds. That doesn't mean equities can't continue to rally, but it does suggest there's a question mark as to whether on a medium-term basis you're being properly rewarded for taking equity risk in the UK. Conversely, in the UK and Europe, equities still look relatively attractive. The equity risk premium is there. You are being paid a premium to take the equity risk. And that's effectively what this is showing, which is, again, a long way of saying that there are some question marks over valuations, particularly in the US. Fundamentals are probably going to have to do some work to catch up to that. And the final slide I will talk about on my section, the next one, is just on gold. I thought it would be worth touching on. Gold is something we think about quite a lot. Gold continues to do well, surprisingly well. It broke through the 2,000 mark a couple of years ago and continues to move from strength to strength. This is a little bit surprising, something we'll look at in more detail in the future. Remember, gold doesn't have a yield. It has no cash flow. It just sits there looking shiny and pretty effectively. So it's very surprising, particularly as interest rates go up, that a non-yielding asset performs so strongly. But some of the reasons for that, what it does suggest is people are using it as a store of wealth. Gold has abilities that central banks can't print it. It's independent of those central banks. So it can be used as a store of wealth. It might suggest that investors are a little bit wary of holding bonds or fiat currency elsewhere. There's also quite a lot of central bank buying. As central banks look to diversify their exposure away from particularly US treasuries and other bonds, they're buying up gold at quite a rate that's supporting that price, but it is noteworthy. But that's it for my section. In summary, markets have rallied, equity valuations look a little bit stretched, but they do have momentum behind them. We need to see if fundamentals can catch up to those valuations. That, I think, is a great opportunity for me to hand over to George, because economics and fundamentals and everything underlying, that's what drives that fundamental growth. So we can't really make a call on where we think markets will go without talking about fundamentals. So, George, over to you.
Thank you very much, Ben. So let's take a look at the larger picture, right? Because as Ben told us, we have a stock market rally. As you will see, the fundamentals, at least the economic fundamentals, are not that great. And within, equities, there isn't a clear story as to what's driving them. And a lot of people out there in the market right now are trying to figure out, okay, is this bull market a false flag? Is it something we should ride because, interest rates are coming down and that's it? So what I'm showing you is, and I've never shown it really before, is a tool that we have devised, a very simple tool, where we try to look at all the key issues that might affect risk. So In terms of lowering risk, there's still a lot of residual liquidity in the markets from the days of quantitative easing. The end of rates is drawing closer. Macroeconomics, as you will see, are not bad. They are resilient, especially around consumption and employment. There is disinflation, mostly coming from China. The financial sector hasn't blown up yet, which is always a good sign. We are growing closer to a new cycle of capital expenditure. We want to achieve that green transition and what have you. And also fiscal policy is somewhat loose. Governments are spending money because they're up for re-election, some of them, and they don't have a recession on their cards. Having said that, there are still factors that are elevating risk. For one, we are in a period of quantitative tightening. So for years, we were in a period of quantitative easing. Central banks were printing money. Now it's the opposite. They're drawing money from the markets. And although nothing's broken yet, nothing has happened yet, which if you ever hear to those webinars, it is somewhat surprising to me. Good surprising, but surprising. Still, we count it as something that is risky. Inflation is coming down, but services are sticky, especially in the UK, because the labor market is a bit tighter. There is the issue, and we shall not touch very long on this in this call, but there is the issue of geoeconomic fragmentation, i.e., what used to be in a decade and a half ago, a more smoothly functioning world where economies were cooperating to get goods and services from point A to point B. Now, this is a more fragmented world. It's beset by trade wars, and this is having a real impact on the global economy. Despite the fact that we see rate cuts going forward, real rates are tightening. If inflation is coming down and your interest rates haven't changed yet, they will, but they haven't changed yet. That means there is still tightening going on in terms of the economy. Valuations, they're not exorbitant, but they're not very attractive either, especially in the US. They are about 15% above the average. Due to geoeconomic fragmentation reasons, trade has become cumbersome, and that has had an effect on demand. That's why global manufacturing can't seem to rebound very well. Corporate health is deteriorating. A lot of companies built their business models on the idea that interest rates would be near zero or very low for a very long time. And this is not quite happening. In fact, we could see I don't think we'll see interest rates near zero for a long time now. So this is burdening a lot of corporates around the world, including the UK. China is slowing. It may be deflating on the one hand, but it's also slowing. So that has an impact on the global economy. And overall, the debt burden is rising, especially in the US, which is projected to have 137 debt to GDP by the end of the decade. We're talking about some really high numbers now and some really high debt servicing costs. Now let's pick up on some of those issues. Next slide, please. So the first is, let's see where the economy is. Right now, and you can see that mostly on the right-hand chart, which is a very quick model we put together with 87 macroeconomic variables. The US and China are in a slightly better place than Europe and the UK. This is for two reasons. In the UK, it is because, well, 2/3 of its trade happened with Europe, so it's largely influenced by what's happening in Europe. And Europe's growth is lackluster, because it doesn't really want to borrow much to improve its economy, and also Germany has been losing market share to Chinese electric vehicles for some time now. Meanwhile, the US and China are in a more stimulative part of the cycle. So the US is stimulating fiscally, China is both monetarily and fiscally stimulating, and that is helping the macroeconomy somewhat. Next slide, please. So talking about geoeconomic fragmentation, this is the economic cycle, by the way. On the left-hand side, as you can see, the central bank at some point loosens, and that kicks off a new cycle because interest rates are low. And by the way, how do we build a factory? The best way we build a factory is not with money from our own pockets. Rather, we borrow money from a bank, a private equity, friends and family, whatever, at a certain rate, which is usually tied to the central bank rate. And then we do an investment and hope that this investment will give us a better rate of return. So we earn on the differential of interest rates. This is how most businesses are run. So lower interest rates means more commercial activity. We grow on the back of that. And at some point, for whatever reason, it could be 10 years down the line, we get inflation. This forces central banks to tighten. The first thing that goes is the financial market. So that's your financial recession. The second thing that goes is the economic recession, or at least a very pronounced slowdown. Finally, at some point, inflation is lower because demand is lower because the economy is not doing so well, that the central bank start rethinking about lower interest rates again to stop stifling economic activity, which kicks off a new cycle. Now, what we have is the major trading blocks of the world in different parts of that cycle. China is a little bit ahead of everyone because it's now to the point where economic growth has not been good for some time and it's stimulating a lot. The EU and the UK are seeing lower growth and especially in the EU, lower inflation. So they're at the point where they should be cutting rates at some point soon. The US, on the other hand, is seeing slightly better growth and slightly more persistent inflation. So it's a little bit further back in the cycle, which is completely stylized, of course. Next slide, please. Now, as I said, and we will be getting back to this in following sessions, sorry, I lost my train of thought. Europe is not borrowing money because a recession is a choice in this monetary world, right? Countries can borrow a lot of money. They can print money to get themselves out of a recession. And the UK and the US can borrow. Europe would borrow if it could, but it has the Stability Pact, which tells countries that to maintain the integrity of the euro, they should not be borrowing more than 3% of their GDP. They have been breaking a lot, been breaking it a lot in the past due to crisis, but now some northern countries are drawing a line, which means slower economic activity in Europe. Next slide, please. Now, because the US is doing a bit better, and the numbers are showing it, in December, markets were thinking that the US would cut rates. A cut is 0.25%, 7 times. Now the number is down to 3. And pretty much these are the numbers for the UK and the EU. Markets were expecting 7 rate cuts. They were expecting a steep recession, which never happened. And at least that's what they were pricing in. And we're getting, much better macroeconomic data, which also means less interest rate cuts this year and probably more towards the second half of the year, from the summer onwards. Next slide, please. In terms of the US, inflation is somewhat stubborn. Okay, on the left-hand side, you can see that CPI, Consumer Price Index, has picked up for the 4th consecutive month. But on the right-hand side, you can see that core services inflation hasn't been dropping as much. Okay, it might have inched down a little bit, but it hasn't been dropping as much. And the reason is energy prices can go down. That's the goods and the energy part of the inflation. But once workers have a mindset that after many years of very low growth, they can go finally back to their boss once a year and ask for a raise more easily, as they have in the last 3 years, they're more likely to repeat that. Most of the inflation that we're seeing now in the West comes from services and comes from wages. Okay, we do see an uptick in inflation due to higher producer prices, but that is some way from being translated into a next, third big inflation wave. Now, on counterbalancing this, next slide, is China. And China is what keeps everybody's inflation low right now, lower than it should be otherwise. Why? Because China has stopped trying to cater to the internal consumer, and it's been building factories, which means it has been increasing slack, and it's been diverting money from real estate, which is crashing, to building more manufacturing. So it's resuming its mantle as the world's cheap producer of stuff. Okay, and in the past, if that deflationary effect was somewhat tempered by its very quickly growing real estate market. You build homes, you need copper, you need aluminum, you need a lot of goods, you need energy. Now you don't have that. You have a crashing housing market, which means that those costs are lowering. Next slide, please. Meanwhile, in the West, especially in the US and the EU, US manufacturing is weaker. And we anticipate that weakness will persist. If you can show the next slide, please. Because there is a lot of slack, there are a lot of excess inventories. Okay, so after the pandemic, factories built large inventories because they expected supply chains to be volatile. Now they need to get rid of those inventories before they ramp up production again. So that's why manufacturing will probably not pick up and not, want more commodities, which could put a much bigger upward pressure on producers. So when all is said and done, we do not see any elements of the next inflation wave, bar a geopolitical accident, which is, as of this moment, unpredictable. Next slide, please. So there are two types of inflation, really. On the right-hand side, it's monetary inflation. We print a lot of money. At some point, that becomes too much, and then that becomes inflationary, and then we have to withdraw that money from the market. But what we experienced is the inflation mostly on the left-hand side, supply side inflation, where you have supply chains not working very well, which means that we have a spot of commodity inflation, which then leads to consumer inflation, which then is going to lead to higher interest rates, which will then lower demand to lower inflation. That process is not as cyclical. You see that last arrow there? That's missing. Okay, and that's for a very good reason. After we lower inflation, unless we have a new supply chain disruptions, this part of inflation could be over. So it's not, by the way, we have both elements, because Mr. Trump printed a lot of money and printed a lot of checks, and he gave them to Americans, and it really increased the supply of money in the US. But most of that is gone now. Most of that is spent. But mostly the type of inflation we have been seeing is supply side inflation, especially in the last few months. That's what we're suffering from, the early stages of supply side inflation. Meanwhile, next slide. The Chinese economy is still weak. So if you're still afraid about inflation, then keep in mind that China, the world's fastest growing economy at some point, is not doing that anymore. They're not growing as fast. Yes, the industry and the capital expenditure have somewhat rebounded, but retail sales are weak and property investment is literally tanking. So, we don't see inflation coming out of China anytime soon. Next slide, please. So this is where this leaves us. This is inflation in the past in the past year or so. And as you can see, in the past 3 or 4 months, the numbers have been coming down. We're now to the stickier part. It's much easier to get inflation down from 10% to 4% than it is to get it from 4 to 3 and from 3 to 2, because that's your residual services inflation that that keeps causing headaches for policymakers. Now, you all have portfolios. Okay, and I understand inflation and geopolitics and the economy might be fascinating things, but when it comes to portfolio management, most portfolios have bonds in them, especially the more defensive ones. So the question that we're faced with is, fine, in this world, what will happen to bond yields? Because bonds had a miserable year in 2022, the worst ever in recent recorded history in like 100 years. So those investors have been hurt, and the question we're trying to answer is, fine, if we buy a bond now for the yield, are we going to see some sort of better return, i.e. lower bond yields and maybe an improvement in bond returns? Now, next slide, please. And this is the final one, and I would like to leave it with some food for thought. Right now, we don't have an answer. We're trying to find an answer, but in all honesty, we don't have a definitive answer. Theory says that in a world of in a world of so much debt, investors would require higher yields to buy that debt, even American debt. Okay. On the other hand, and global debt to GDP is 330%, up from 220 about 2 decades ago. The other theory says that governments might not like that much debt on their balance sheet, and they're going to have a real problem paying for that debt, the interest payments. So they might try to impose themselves upon central banks and keep yields lower for longer so that they're able to service that debt. Okay, and I understand central banks are technically independent, and it does fall within the realm of speculation. But we have seen crazier things in this world than a treasury and a central bank working close to one another. So with that, I would like to pass the ball back to Ben for his thoughts on the subject, and then maybe we can open it up to Q&A.
Thank you very much, George. A great thorough roundup of the economic outlook. As we said, all a little bit mixed, all to play for. No certainty, but certainly things that we're focusing on a great deal, particularly how do governments and central banks think about monetary and fiscal policy. And there's always the technical answer, but then there's the murky reality that we live in. It is now coming up to 22:11, so I might just move straight towards the Q&A. I can see that we've got one already. Again, if you have any questions, please drop it in the Q&A box and we will take a look. Before we do that, I would like to remind everyone our next webinar is on Wednesday, the 29th of May. So please do sign up to that one. And I will pick up some of the questions now. There's a couple we had submitted before. One I will just flag. One is from an individual saying they're going to set up an investment company, give the shares to partner, grandchildren, children, asking about SDLT and CGT, so tax on valuation. What happens if that is then transferred, and how long CGT liabilities go? We can't talk about individual tax circumstances on this call, and it's not, strictly speaking, our remit. What I would say is we have an excellent tax team here at Mazars. One thing that I like about the company, we have so many talented teams covering a broad range of abilities. So we have a great tax team here. What we will do is follow up with the individual after this call and put you in touch with the tax team. One of the other questions that came in before, it's a great question, but I'll take it a slight tangent. It says the government is always looking for revenue. One option suggested is, what if they had a 10% share of the top 5 energy, bank and defence companies? How much would they need to invest? How much would the annual income would they receive? What I would say is, I won't answer it directly. What I would say, you've got to think about the magnitude of government versus companies. Governments are huge, and even the UK economy is that much smaller. To give you some idea of revenue, the government's annual revenues are just over £1 trillion. And rather than look at those top 5 energy, banks and defence companies, what you can do is look at the top 10 dividend payers. So if this is about generating revenue, the top 10 dividend players, that's the likes of British American Tobacco, Unilever, and some other names. Their market cap is about 333 billion in all. Most of them are in the tens, maybe hundreds of billions size. So if you're only looking at 10% exposure, then that's 33 billion of assets. The yield you get off those high earners is about 5.8%. So even if the government was to take a 10% stake in those largest companies, all they're getting is just under 2 billion in revenue compared to the 1,000 billion of government revenue overall. But governments don't have to invest directly. We're not at the moment in an era where we have huge state-owned enterprises. But it's worth remembering governments don't have to own these equities to benefit from them because you have corporation tax. So every company in the UK has to pay 25% of its profits before tax as corporation tax. So it's definitely the government is looking for other ways of getting revenue, but rather than having to worry about dividends, which are variable and at discretion of the board, they can do it directly through corporation tax. So obviously that the move from 18, 19 up to 25, they do that instead of having to take the clunkier route that people like you and I are reliant on to try and try and deal with. So that's what I'll cover there. Some of the questions on the call, I might sort of alternate these with George. The first one I'll answer because it was on one of my slides. Does the equity yield refer to capital or income appreciation? This is about price. So it's not dividend, it's not the income. Companies get an earning if you own if you own shares in a company, all of the shareholders in aggregate have the right to that earnings. In reality, there's then a split to how much is reinvested, how much is paid out. So there's a payout ratio that says how much of the earnings are paid out as income. This is really just a technical measure that says the earnings that the company has versus its price, which is slightly more related to capital. It's a valuation measure rather than a sort of portfolio, a return measure, which is how we think of as income or capital appreciation. I'll bounce the next two to George. So there's one. Is this a good time to invest in property? George, do you want to invest in property?
Sure. I'm an expert in property, but in my humble experience, there's never been a bad time to invest in property. At least housing, especially in the UK, because demand really outstrips supply. And it has done so for a very long time. In terms of commercial property, yes, things are looking bleaker because nobody wants to return to the office. Okay, and managers have to whip people back into it. And after feeling the joys of hybrid working, it's very difficult to see people going back in the city for 5 days a week. So commercial property is definitely in the doldrums.
Thank you very much, George. I might bounce the next one to you as well. What level of pay increases are forecast for the UK this year? Ties in very closely with the wages and inflation discussion you were just having.
Yes, so I'm not sure exactly. I would expect what's right now wage increases in the UK are circa 5%, 3 to 5%. That's where I would expect that slightly less in the next year. It's a difficult question because we're seeing lower inflation, so less people are going to go to the boss and ask for a raise. And if we see lower interest rates by the end of the year, people might be patient until that happens because everybody's got a mortgage to pay. So very tentatively, I'd say a 3 to 5 number looks decent.
Thank you very much, George. Another question that I'll field that was sort of pre-submitted. This is about the relative size of companies and equities, and it's relating to a recent article that says the top 7 US companies, the FANGs, 60 to 70% of the total value of the Dow. It's distorting the true price of the Dow index. So the first question is whether that's correct, and then without those 7 companies, what's the US market look like? And then it follows on to say, those top 7 companies are bigger in value than the FTSE 100 in total, and if that's correct. And so I guess it's worth putting in context. The US market is huge. 60% of global equities are in the US compared to the UK, which is actually a relatively small part of global markets, around 4%. But I think it means, what do you mean by the market? So if you do things by size, most indices are dominated by a small number of very large companies. That distribution is true in the UK, it's true in the US, but it's massively amped up in the US because you have these global mega caps that just dominate the world and happen to be listed in the US. So it depends if you mean a bit like with football. When people talk about football, you tend to mean how a team's doing in the Premiership, not realizing that if you talk about how is football doing in general, there's dozens of leagues below, all the way down to sort of people that play in the park. So if you are saying on a market cap weighted basis how a market's doing, then indices are a fair reflection. They are dominated by the biggest hitters. Conversely, if you want to know how is the average company in a region doing, then that's a different consideration. It depends what you think the index is. We think about both. So we look at indices like the S&P 500, that is better measure than the Dow. We look at the S&P 500, same as everyone else, that's market cap weighted. How is that index doing? How are the largest companies doing? We also look at an equal weighted measure. So that tells you how is the average company doing, and that's where you get this sort of breakout between the two. And yes, the top 7 companies in the US are so massive, they tend to dwarf everything else, including the FTSE 100 market cap is about 2 trillion. That's easily dwarfed by the top 10 constituents in the US. But again, these are skewed at the top. So the top 10, all over 1 trillion. Apple more than 2, Microsoft on 3 trillion, Amazon a couple of trillion, Nvidia a couple of trillion as well. But then it does tend to drop down quite quickly. It's the same, sort of in the UK. The biggest UK companies, Shell and AstraZeneca, they're about 170, 160 billion, so a fraction of the size, but it drops off pretty quickly. HSBC is 120, then you're below sort of 1 billion. Indeed, the 10th largest stock, British American Tobacco, is sort of only 50 billion. So to give you an idea, the largest companies in the UK, so Shell and AstraZeneca, they're about the same size as Disney and McDonald's. If you strip out those mega caps, the average company in the S&P 500 is about twice as big as the average in the UK. So hopefully that gives you some sort of some guidance on that. Coming back to the questions in the box, another one for George. How's the 10% rise in the UK minimum wage from April consistent even with 3% inflation? So many businesses will need to pass costs on. George?
A 10% in the minimum wage does not equal a 10% rise in overall costs, right? It is a much smaller part of that. This will pertain to employees who are receiving a minimum wage. Having said that, will it affect inflation? Yes. Inflation, however, in the UK is projected to be 2% or even below by the end of the year, and this thing has been more or less priced in. So, and to not to put too fine a point on it, but we are past the days where companies can easily pass those costs on. Okay, if they're in any sort of a competitive environment, they might, they might find that customers are not willing to pay for the produce. So it could as well reduce corporate margins, a lot of which have in fact been inflated in the past few years of the pandemic. So it is consistent. Yes, it can happen. It is a factor that pushes up inflation, but there are other factors that are mitigating it.
Thank you very much, George. I'll pick up another one. So there's a question here about AI. This is a fantastic opportunity for me to look very stupid. It says, with a recent announcement by Microsoft pushing ever harder into AI, is this the new paradigm, and the impact on the equity markets could be very profound over the next few years? or is it another dot-com bubble? I'll see if George has any additional comments because it is obviously a big topic. I mean, my sense is a lot of enthusiasm has been driven by AI. I think the outlook is unknowable. I tend to buy into the Bill Gates adage that markets tend to overestimate technology in the short term and underestimate it in the long term. I think it obviously has the potential. The two biggest challenges in markets, and this is a bit of a truism. They say that the most dangerous word in investing is this time is different, but every so often there is a regime change and there is no way to tell in advance. So certainly I see the potential of AI to change productivity. A lot of investment is going in, and it is a technology that can scale very quickly. It is worth remembering there's a lot more positive earnings growth already. There's a lot more profitability. There is that much less pie in the sky from the dot-com bubble. A lot of the enthusiasm is around the hardware needed to run this, and that is something people are buying and putting in. I think it is dangerous to draw a few dots in terms of productivity growth and then extrapolate that up in a straight line into the future. So, I think valuations are quite rich. There is disappointment risk if it gets out of hand, but I think markets are pricing in a possibility, but not a guarantee of AI productivity gains. George, I know this is something that you've thought about as well. But any additional
Well,
comments?
yeah, Ben. So what I think about is cockroaches and dogs. We hate cockroaches, although they're not particularly nasty, and they, contrary to popular wisdom, they will not give you much disease. But we love dogs because they have puppy eyes, and we can make some sort of contact with them. Human beings are innately driven towards something that looks like them. Okay, and we tend to attribute, if those dog owners or cat lovers amongst you, we tend to attribute human emotions to reactions of dogs and cats, which can actually, be very different, mean a very different thing. So AI has been around for some time. So has machine learning. Okay, and 2 years ago, or is it been a year ago actually, a year and something ago, one AI spoke a language which sounded very human, large language models, right? Your ChatGPT. And suddenly we had a rally like no other. Are we getting ahead of ourselves? Absolutely. Will this thing lead to somewhere? Absolutely too. But we have no idea where. Where we are today is we're back in 1994, where we have the internet in front of us, and Time Magazine was talking about using it to send emails and how awesome that is. The internet has since dominated all of our lives. We have no idea what changes AI will bring forth. Okay, are they going to be large? Likely, yes. But we're still at early stages. And there's going to be patience needed. There's going to be hardware needed, some of which is not there yet. And there's going to be a lot of energy needed. Okay, that last part is difficult.
Great. Thank you very much, George. We've got a few minutes left, so I will tie a couple of these together. There are a couple on central banks and rates, so I'll tie together. There's one in the chat that says, do you think central banks will achieve 2% inflation targets, or mid-single digit inflation is useful for policy setters to help them reduce debt levels? That combined with another question about the bank, Mervyn King, previous governor of the Bank of England, says in his book that a rule of thumb that the gap between inflation rates and interest rates should never be lower than 2%. So if inflation is going to be 2%, the bank rate should be 4% at a minimum. So, George, what's your thinking around that?
The thinking is, I don't know yet, man. That's the answer. I think central banks will achieve what they set out to, but you see, the point is we say central banks, and what I've always wondered is whether central banks are whether it's central banks driving this, or central banks are helping inflation get back down to where it's supposed to be. And that's the answer I don't have. I think the central bank participation, this whole thing, might be also somewhat exaggerated. Some things run natural cycles.
Thank you. It's a difficult one, and it's very much a live debate that we're all having in the industry, and we'll continue to talk about, I have no doubt. Last few questions, a couple of quick ones. One, please confirm UK gilts are currently returning, and if it's a fair return, given higher interest rates available. I mean, currently the 10-year gilt is about 4%. I think they are all returning a fair value insofar as their current value in the yield is the chained expectations of future yield. So I think where UK gilts are now is a fair reflection of the higher interest rate environment that we're in. And as you saw earlier, I showed that where markets expect interest rates to be over the next few years, they are bang in line with that. Now, whether those expectations change is a different question, but certainly I think those returns are sort of pretty fair. And then there is a question on the outcome of elections in the UK and US. I'll just give a quick answer, see if George agrees or disagrees. I don't think the elections in the UK or US are going to have a big impact on valuations. I think what happens with rates and other developments and recession risks and all sorts of factors like that are going to be a much more powerful driver. I think in the US, both candidates are relatively known quantities. No one's expecting huge surprises. Similarly, in the UK, unless there is a radical surprise, a lot of this is known, and no side has the huge ability to drastically change policy. They can't borrow much more. The economy is where it is. So I think we'll talk a lot about elections and what it means. Personally, I don't see actually much scope for an impact on equity valuations. George, do you think anything different?
If a UK government, be it Tory or Labour, start coming closer to Europe, this could potentially unlock some value in the eyes of international investors. Okay, the proximity of the UK with Europe is probably one of the biggest drivers, can be one of the biggest drivers of flows into UK equities. The next issue with the US election, I tend to agree more with Ben, with a caveat. If the Republican Party, because I wouldn't see the Democratic Party achieving that, if the Republican Party, or if any party for that matter, achieves control of all three branches, two branches, the executive and the legislative, both houses of Congress and the White House, this unlocks government in the US. And this is where things happen. That's why US equities rallied in the first 2 years of Trump. By the Trump up was what, 33%? Okay, so for example, if a Republican government pushes back on legislation to curtail, which would otherwise curtail bank lending, this could have a huge impact on the economy and profitability. If they further cut corporate taxes, this could have a huge impact on valuations. But for that to happen, you will need one party, and possibly the Republican one, to win the House, the Senate, and the presidency, which is not the most likely of events right now.
Great. Thank you very much, George. That's all we have time for. So again, next webinar on the 29th of May. Thank you all for listening and all of your questions, and we'll see you next time. Goodbye.